Merry Christmas and welcome to Investor's Guide. This is the second leg of our three-part special that we're putting together for you so you can invest better in the new year. As always, Dhirendra Kumar joins us now in our Delhi studio. Dhirendra, thank you so much for spending time with us and Merry Christmas to you. Now, to help us rejig our portfolios, he joins us now. We're going to pull up each of the portfolios that we designed 2 years ago. For those of you who are new to the Investor's Guide family, these are portfolios we designed based on age groups. So there are 5 portfolios and they're based for age groups 25, 35, 45, 55 and 65. So you can decide which portfolio suits you best. Now, we've been hypothetically investing 10,000 rupees in these portfolios every month since June 2009 to see how they perform. We're going to revisit the returns it's given us to find out, especially in a market like this, if this is the portfolio you should be investing in. Now, you can write to us on the email ID at the bottom of your screen if you have any questions about what you hear on the show today. So let's get straight to it. Grab a pen and paper. We're talking first about our aggressive portfolio. It's designed for a 25-year-old. I want to start by pulling up a case of someone who wrote to us. Ananya is a young person. She has ambitious goals for her money. Take a look.
Young Ananya dreams of buying her own car someday. And while she balances her job with studying for the GMAT, she still finds time for her brand new interest, the stock market. With savings over a lakh in fixed deposits, she now wants to focus on investing directly and indirectly in the stock market.
I want to accumulate rupees 4.5 lakh by mid-2014. Is my portfolio on the right track to achieve my goal?
Like many other investors, Ananya is concerned that the DTC might eat into her savings next year. But this 25-year-old still hopes to find the best possible investment for her money.
Alright, so that was Ananya. She wants to build a corpus for the next few years. But Dhirendra, do you think that she might be able to use our aggressive portfolio? Is that something that she could use given her age group?
Given the age group and if it is a retirement portfolio, this is an excellent portfolio. But if one is likely to, expect return or realize these investments in 3 to 5 years' time, then it may not be a very desirable way. You might be in for a surprise. There are long stretch of, there are long periods when the markets don't do well, and you have to keep the faith and continue on, stay on course with your plan. So it is an excellent portfolio. It's an excellent growth portfolio. Fund selection is very good, but for many years, it's a great way to accumulate. 3 to 5 years time frame, it may not be the very appropriate way of approaching it.
Well, you talked about long periods of time when the market doesn't perform as well as we would like it to. Now, we're possibly seeing one of those periods at this point. Would you recommend investors of our aggressive portfolio just keep the faith and continue investing?
Absolutely. Most investors want that their investment should be doing continually well, which doesn't happen. It happens with fixed income, but it doesn't happen with equity. And that is, that is why, if you're accumulating over a period of time for many years, one should keep the faith, and not only keep the faith, psychologically prepare yourself that you are benefiting from it, you are buying cheap. Unless until you change, you have that mindset, it will be extremely difficult for you to stay on course. It's far easy for me or us to, think that stay on course, think long term. But when you have your accumulation which goes down in value by 25%, it's quite unnerving. Most people, try to move their money at the very inappropriate time and try to get into the market. So one is that, investing gradually helps you build that mindset. The other is that if you are sure of, you are unlikely to need that money, that is extremely important. If you are likely to need that money in 1.5 years time frame, thinking long term doesn't help because it's not a long term investment. So if those variables are in place, I think it will help you stay on course.
All right, I want to go through our aggressive portfolio right now as it is. We have invested in the TSP BlackRock Short Term, HDFC Equity, ICICI Prudential Dynamic, IDFC Premier Equity Plan A, Reliance Regular Savings Equity, UTI Opportunities and L&T Opportunities. Now, this portfolio has lost about 5.5% annualized over the last 2 years, which is not bad given where the market is right now. The top performer is the short-term fund. There's no surprise there. The worst performer is HDFC Equity. It's down 24%. Dhirendra, when you look at this portfolio right now, are you tempted to make any changes?
Yes, some changes. L&T Opportunity has been a disappointing holding in this portfolio. That gets knocked. The other one is Sundaram Smile, which is also proving to be a fairly average small cap fund. So that also gets replaced by Magnum Emerging Business, and L&T Opportunity gets replaced by a relatively more stable investment, which is not necessarily an exact substitute, but given the complexion of the market, it is getting replaced by Quantum Long-Term Equity Fund.
So we've made two changes to our aggressive portfolio. We're replacing Sundaram Smile with the Magnum Emerging Business Fund, and of course we're replacing L&T Opportunities with Quantum Long-Term Fund. All right, so moving on, we have another portfolio. This is our growth portfolio. For those of you in the age group of 25 to 35, you can pick between the two of these portfolios based on your aggression for returns and how much risk you want to take. Now, the investments in our aggressive portfolio are Birla Sun Life Frontline Equity, Candour Robeco Income, DWS Investment Opportunities, TSP BlackRock Top 100, FT India Dynamic P Ratio Fund of Funds, HDFC Top 200 and UTI Dividend Yield. Now, this portfolio has lost 4% over the last 2 years, and you can see that difference there in the aggressive stand that the two portfolios have taken. Now, Birla Sun Life Frontline Equity is the worst performer right now. When you're looking at this portfolio, Dhirendra, are you tempted to make some changes here as well?
Yes, we only have one disappointing performer, which is DWS Investment Opportunity Fund, and this should get replaced by Mirae Asset India Opportunity Fund, there's no tax implication if one gets out of this fund, and because all the limited gains which one has will be entirely long term.
If you have questions about anything you heard, feel free to write to us on the email ID at the bottom of your screen. We're going to come back after this quick break. We're going to talk to you about investing when you're 45 and when you're 55 years old, and we'll talk about the portfolios we've designed for you as well. Come back quickly.